Two people, same income, same city, same salary landing in the same direct deposit every 2 weeks. One of them calls his bank and waits 11 minutes to speak to someone who reads from a script. The other calls a number that rings twice and a person who knows his name picks up. Same income, different outcome. The difference is not the income. It was never the income. What separates those two calls is a ladder most banks will not describe to you directly. Not because it is secret exactly, but because the people who benefit from your not knowing it are the same people handling your money. This video is going to walk every rung of that ladder from the first tier, where most people spend their entire financial lives, to the level where a family's balance sheet starts to look less like a personal account and more like an institutional one. We are going to cover the thresholds, the services that unlock at each level, what the bank actually wants from you, and where the conflicts live. No luxury fantasy, no aspirational fog, just a structure as it actually works. Here is the basic shape of it. The ladder has 5 recognizable tiers: retail and mass, affluent at the bottom, private client above that, then private banking, which is where the language and the treatment change in ways that are genuinely meaningful. Above that is ultra high net worth, where specialists start appearing around a single relationship. And above that is multi-entity coordination, the level where a family's financial life requires something closer to a small institution than a bank account. Each tier has an approximate threshold in liquid assets or assets under management. Each one unlocks different things, and at each one the bank's incentive structure shifts in ways you should understand before you sign anything. The first thing to understand is what a bank is actually selling you and what it is buying from you at the same time. The bank is selling advice, access, speed, and structure. What it is buying is your deposits sitting on its balance sheet, the AUM fees on assets it manages for you, the spread on any lending you do through them, and what the industry calls cross-sell stickiness, which is a polished way of saying that once your mortgage, your investment account, your business line of credit, and your trust are all at the same institution, leaving becomes genuinely complicated. That is not accidental. The structure is designed to deepen the relationship because a deeper relationship is more profitable for them. Knowing that does not make the relationship bad, it makes it legible. 3 levers determine where you sit on that ladder. The first is liquid assets, meaning investable assets, cash, and the accounts the bank can see, manage, or custody. The second is credit quality and collateral, what you own that can back a loan, how predictable your income is, how clean your credit history reads. The third is complexity. A person with a concentrated stock position in a single company, a small business with irregular cash flow, a real estate portfolio, a trust from an estate, or equity vesting on a schedule, that person generates more fee opportunity and more advisory need than someone with a simple W-2 and a Vanguard account, even if the dollar amounts are similar. Complexity is a ticket. Banks price for it and they recruit for it. Who you actually deal with changes at each tier, and that change is more significant than most of the marketed perks. At the retail level, you deal with whoever picks up. At the mass affluent level, you might have a branch advisor who also handles 40 other clients and primarily sells products. As you move into private client and then private banking, you get a named relationship manager. That person is accountable to your account. Above a certain threshold, the relationship manager is backed by a specialist bench, a lending officer, a trust attorney on retainer, an investment specialist, a tax-adjacent planner, all coordinated through one point of contact who knows the full picture of your financial life and holds the relationship together. That quarterback model is not a perk. It is a different kind of service. The difference between one generalist and a coordinated team is the actual value proposition at those levels. Now, the reality check, because this is where most coverage of private banking drifts into brochure language. The perks that get marketed, the metal cards, the airport lounges, the concierge line, those are retention tools. They are real in the sense that they exist. They are not the reason to care about where you sit on this ladder. The reasons that actually matter are credit pricing, because a private banking client borrowing against a portfolio pays meaningfully less than someone walking into a branch. Speed and structure, because a complex mortgage or a securities-backed line of credit closed in 10 days instead of 45 is worth real money. And access to products that do not exist at lower tiers, alternatives, private placements, trust structures, concentrated stock strategies, the conflicts are just as real. The bank earns more when it manages more of your assets. It earns more when you borrow through it. It earns more when it places you in proprietary products. The advice you receive is shaped by those incentives, whether your advisor acknowledges it or not. Legibility is the only protection. You cannot navigate a ladder you cannot see. This is that ladder. The first real rung begins around $250,000 in liquid assets. Some institutions draw the line at $200,000. Some at $500,000. The number varies by market, by institution, and by how much the bank wants your segment. What does not vary is what the threshold represents. Below it, you are a retail client with a slightly larger balance. Above it, the bank begins treating you as someone worth assigning. The private client tier, roughly $250,000 to $1 million in liquid assets, unlocks a named contact, not a branch advisor who rotates, a relationship manager with your account in their book. The practical difference is speed and context. When something needs to happen, a wire, a rate question, a document, you call a number that rings to a person who already knows what you own. That person also has slightly more authority to escalate. Mortgage underwriting that would take 6 weeks in a branch takes 3. A rate exception that a branch manager cannot approve a private client RM can surface to someone who can. What the bank wants from you at this tier is deposit sitting still and the beginning of a managed relationship. They want to move your brokerage. They want to know about the 401k you rolled over somewhere else. They are building a picture of your full balance sheet, not because they are altruistic, but because every account that sits outside their custody is revenue they do not have. Cross $1 million in liquid assets and the language shifts. Private banking, not private client. The distinction is more than marketing. A dedicated relationship manager now has a smaller book, which means more attention per client. Faster underwriting becomes a structural feature rather than an exception. Cash management gets coordinated across accounts. And specialists start appearing, a lending officer who knows your file, an investment specialist who builds beyond the model portfolio, a mortgage officer who has closed deals in your income category before and does not need the transaction explained from the beginning. Real estate financing changes at this tier in ways that are concretely valuable. Jumbo mortgages get priced better. Portfolio lending becomes available, which means the bank underwrites against your total financial picture rather than a rigid debt-to-income formula. If your income is variable, if you are a business owner, if a significant portion of your compensation is in equity that has not vested, a portfolio lender can account for that in ways a conventional underwriter cannot. That flexibility has real dollar value at closing and at every refinance after. Securities-backed lines of credit open up here as well. An SBLOC is not margin. It is worth being precise about the difference. Margin borrowing lives inside a brokerage account and is governed by Regulation T, which sets fixed maintenance thresholds. An SBLOC is a separate revolving credit facility pledging a non-retirement investment portfolio as collateral. The bank assigns a haircut to each asset class, typically 50 to 70% of equity value, 80 to 90% on investment-grade fixed income, and extends a credit line against that. You draw on it like a home equity line. The rate floats near SOFR plus a spread, usually meaningfully below what a personal loan or credit card would cost. The risk is not theoretical. If the portfolio falls and breaches the collateral threshold, the bank issues a collateral call. If you cannot cure it with cash or additional assets, they sell. They choose what to sell. The timing is theirs. In a market decline, when the portfolio is already down, forced liquidation at the bottom is a real outcome and not a remote one. Convenience on the way in is a different thing than control on the way out. The bank has a control. At $5 million and above, the UH&W coverage tier begins, and a specialist bench becomes standard rather than optional. Concentrated stock planning enters the conversation in earnest here, because this is the level where equity compensation accumulates into positions large enough to represent a genuine risk. A single company holding representing 40% of net worth is not a portfolio. It is a bet. The bank has tools for this, 10b5-1 plans that establish a predetermined selling schedule outside of blackout windows, collars that cap downside by giving up some upside, exchange funds that allow you to contribute appreciated shares into a diversified pool and receive a pro rata interest in a broader portfolio, deferring the tax event. Charitable vehicles, donor-advised funds, charitable remainder trusts can absorb appreciated shares and eliminate the capital gains event entirely while generating a deduction. Here is what you should understand about the bank's incentive in this conversation. Every monetization strategy they help you execute either moves assets into a managed account where they earn a fee, generates a lending facility they earn a spread on, or both. The advice is not wrong. The tools are real, but the bank is not a neutral party. It earns more when you monetize inside their ecosystem. That is worth holding in mind when evaluating which strategy they recommend first. Alternative investments begin appearing at this tier. Private credit funds, real estate debt funds, Structured notes with principal protection features tied to an index. The access is real. The products are not available at the retail level, but liquidity risk is significant. Private credit funds lock capital for 3 to 7 years. Structured notes have credit risk tied to the issuing bank. Manager access that sounds exclusive is often access to a fund the bank has a distribution agreement with, not necessarily the highest performing option in the category. The fee layers compound. The manager charges, the bank charges, the custody charges. A private credit fund returning 8% gross can return 5.5% net after fees and illiquidity premium is accounted for properly. Watch for pricing opacity at every tier. The rate on an SBLOC, the spread embedded in a structured note, the fee on a separately managed account. These numbers exist. They are not always offered. They are always available if you ask specifically enough. Asking is the only protection you have. Cross $10 million in liquid assets and the conversation changes in kind, not just in degree. Below this threshold, the bank is helping you manage wealth. Above it, the bank is helping you manage a system. Those are different problems, and the gap between them is where most of the complexity lives. The business owner arrives at this tier more often than not through a liquidity event, a sale, a recap, a secondary. The balance sheet before the transaction looks nothing like the balance sheet after, and the window between signing and closing is where the most consequential planning either happens or fails to happen. Pre-sale planning matters because the tax treatment of a transaction depends heavily on decisions made before the documents are signed. Qualified small business stock, the QSBS exclusion, can eliminate federal capital gains on up to $10 million in gain if the shares were held for more than 5 years and the company qualified at issuance. That window does not open retroactively. Neither does an 83B election on restricted property. The bank's planning team will surface these conversations, but the execution requires an outside attorney and a CPA who specialize in transactions, not generalists. The bank is a coordinator here, not a replacement for dedicated deal counsel. Understanding where that line sits is the client's responsibility. After the liquidity event, the post-sale balance sheet redesign is the actual work. Concentrated business risk has been exchanged for concentrated cash risk, which is its own problem. Deploying 8 figures into a diversified structure without triggering unnecessary tax drag, without sitting in cash too long, without over-allocating to any single asset class or manager requires a written plan and a timeline. The bank will build one. Read it closely. The deployment schedule often directs assets toward managed accounts that generate advisory fees. That is not disqualifying. It is worth naming. Trust and estate coordination becomes structural at this tier, not optional. Grantor trusts allow assets to grow outside the taxable estate while the grantor continues paying income tax on trust earnings, effectively making additional tax-free gifts to the trust with every payment. Irrevocable life insurance trusts, ILITs, hold policies outside the estate so the death benefit passes to heirs without inclusion in the gross estate. Charitable vehicles, charitable remainder trusts, charitable lead trusts, private foundations can accomplish giving objectives while generating income streams, estate deductions, or both. The bank has a trust and estate team. They will draft term sheets, model scenarios, and sit in the meeting. They will not file the documents. An outside estate attorney files the documents, and that attorney owes you a fiduciary duty the bank does not. Conflicts surface when the bank's trust company is proposed as trustee. The bank earns ongoing fees as trustee. A corporate trustee is sometimes the right answer. It is not always the right answer, and a bank recommending itself as trustee is not the neutral party to make that determination. Credit at this tier operates across entities, not just against a personal portfolio. Custom real estate lending can be sized and structured in ways that do not exist in the conventional market. Longer interest-only periods, non-recourse structures, cross-collateralization across multiple properties. The more relevant capability is pledged asset lending across a complex balance sheet, borrowing against a diversified investment portfolio, a trust, an LP interest, a combination. Liquidity management becomes a discipline in itself when you hold assets across a holding company, a family partnership, a trust, a foundation, and several individual accounts simultaneously. The bank builds a consolidated picture of borrowing capacity and available liquidity across all of it. That visibility is a service. It is not glamorous, it is operationally significant. Private deals and co-investments appear frequently at this tier. Direct deals in private equity, real estate, private credit, infrastructure. The access is real. The due diligence is yours. The bank will present materials. The bank will not tell you the deal was passed on by 3 larger family offices before it reached you, or that the allocation was offered to clients whose managed account balances they want to retain. Ask who else saw this. Ask what the total fee load is from your commitment to the distribution. Ask about the valuation methodology and the liquidity timeline. The answers tell you more than the presentation does. Family governance formalizes as complexity grows. An investment policy statement documents the asset allocation targets, the risk parameters, the decision-making authority. Entity mapping names every trust, partnership, and corporate structure and how capital flows between them. Consolidated reporting pulls all of it into a single view so the family can see total net worth, total tax exposure, and total liquidity at once. Next generation education becomes part of the engagement at families with meaningful assets and children who will eventually inherit them. The bank runs this as a service. It is also a retention strategy. A beneficiary who understands their relationship is less likely to move the assets when the transfer happens. At some point, the complexity, the staff costs, the number of outside relationships being coordinated, the need for truly independent advice, tips the calculation. A single family office, a small team working exclusively for one family, removes the bank's commercial interest from the advisory function entirely. The hybrid model is common at this tier. A private bank for credit, custody, and cash management, a family office for governance, planning, and manager oversight. The trigger is not a specific number. It is the moment the bank's interests and the family's interests are no longer reliably aligned on enough decisions that independence earns its cost. Every tier on this ladder has a version of that moment. The question is whether you see it coming. Map your own rung. Know what you're paying, what you are receiving, and who benefits when the recommendation is made. That is the only question that applies at every level.